Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, hi everyone and welcome to the latest edition of the show, the ASB Investment Podcast. Today we're diving into the latest ASB, funnily enough, Investor Confidence Survey for the second quarter of calendar 25. As always, I'm your host, a COVID or flu-free Nigel Grant. Joining me today, once again, is our dear friend and senior economist, Mr. Chris Tennent-Brown. We just can't get rid of you, it seems. How are you?
Not too bad, although I did have the man flu, which is, one of the worst conditions.
I don't think it's one of.
Yeah.
It's the.
Yeah. So I survived. But sorry I'm a week late.
That's okay.
To do this recording.
That's
because
okay.
I was at home feeling incredibly sorry for myself.
No one should ever be expected to work on the man flu, isn't it?
No, and it's nice to be back here and in the land of the living and like you say, COVID and flu free.
And what have you been up to since I've been, apart from being sick, anything else?
I went down to Nelson. My brother and sister-in-law Charity, brother Brett, sister-in-law Charity,
yes.
And their coming up 2-year-old Hattie.
Yes. Hattie.
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 Harriet.
Okay.
Yep.
Okay. Right. Yeah.
Yeah. I went down and visited them and caught up with some cousins who would live down there as well.
Yeah.
So that was really nice.
Is it truly the sunniest place?
It was sunny one day we were there and then rainy the next. So I'd say it's sunnier than Wellington, even though it's quite close.
Okay. I thought, was Wellington sunny?
No, Wellington's never sunny, but that's that's not fair. It's sunny sometimes too. I'd say Nelson deserves the sort of sunny reputation.
Okay, well,
but it rained quite a bit on one of the days I was there.
Well, if it wasn't sunny in the weather, having you there would have made it sunny.
That's right. Oh, lovely.
Yeah, that's right. See, that's why I host. So today we're going to unpack what's driving investor confidence as such, what age groups are feeling the most optimistic, and how these global events that keep going on are shaping the financial or the outlook for investors in New Zealand. So let's get into it. We'll start with the big picture. The survey shows confidence is highest amongst those under 39, while those over 60 CTB, not saying you're over 60, are less optimistic. Why do you think these age groups view the market so differently?
Yeah, I think there's all sorts of factors in there. One is time frame, the other is size of investment, and they all flow in. You'd expect, from my perspective, as I approach 60, I'm much more confident about how investments work.
Yes.
But I'm more concerned about market turmoil as I get closer to the time
you need to use a bit of it.
Needing that money.
Yeah.
And when you've got a decent chunk in KiwiSaver, you do notice some of the volatility like we saw in the second quarter. And overall confidence got really knocked around by some of that volatility, I think. On the other hand, if you're at the start of your KiwiSaver experience, for example, even if markets go down 20% over the course of a month, if you're tipping in your second and third and fourth contributions, you're going to notice your balance going up because the contributions are everything at the early stage of it. So just how you'd even approach exactly the same investment differs from age and stage. So it's not even necessarily a risk appetite thing. There's a few drivers there. The other thing, if I looked at our customer base, there's a lot of people that still really like term deposits.
We've talked about that.
And the returns on term deposits have come down and inflation's still there. So that's probably pretty frustrating. And I'd hope that short of people at 20, if they're saving up for a house and need the money really soon or something they need the money for really soon, more likely to be in things like a KiwiSaver growth
lower
fund.
Risk, yeah.
But likewise, at the other end of your life, you're way more likely to be in a term deposit or have some of your savings in a term deposit and perhaps be a bit frustrated by the environment right now. So, I think there's quite a few factors in behind there. But overall, I think the message is that confidence has come back down. It's fairly low and it's impacting all age groups to certain extents.
And I guess from an age group perspective, that's one thing. But are there any, in terms of the latest survey, is there anything coming through from a regional perspective where there's a bit different, diverging perspectives?
Yeah, it's interesting that Auckland's confidence was stronger than Wellington confidence, and Whereas for a lot of the stuff I've been talking about, that's a nationwide sort of experience.
Yep.
And the Wellington housing market's been pretty sluggish, but not significantly more sluggish than Auckland. So there wasn't any one thing I could put my finger on for that particular divergence between Auckland being the more confident and Lower North Island being the least confident area. But actually, if we look at a completely separate survey like a consumer confidence survey, we see a similar divergence where Wellington confidence is quite low. So I think that probably
marries up,
spilled over and marries up with the lower confidence in the bottom half of the North Island. The other thing, if we look at those areas, which is a bit of a counter to the reasons people talk about why Wellingtonians might not be that confident. There's been a lot of change there over the last few years.
Yes.
The housing market has been a bit sluggish. But in the periphery, once we get north of Wellington, there's some pretty decent rural stories out there too. So there's some positive drivers in that same survey area when we dice and slice investor confidence by regions, but it certainly didn't shine through within the overall survey.
And I guess, beyond the survey, some of our recent conversations have focused on we're out of the worst of an economic slowdown. Things aren't firing on all cylinders, but we're kind of, at least it might be, the worst of it might be in the rearview mirror, and we're seeing some green shoots. With the survey in mind, has the view on the current outlook changed at all for you, or is it kind of just more like, meh?
Yeah, I think it's always interesting from my jobs perspective when we go through a really volatile quarter like the second quarter. It generates a lot of work for us to try and help people stick with their long-term goals. What does a volatile quarter like this mean for investors? And when confidence falls away like it has done around the country, it just shows that there's still plenty of work for us to do as investment professionals to keep people abreast of what's going on and help them stay on track with their long-term savings goals. That's the sort of education and support message I get when confidence is taking a bit of a knock like this. But if we look at the economy, investor confidence, consumer confidence, to put it into perspective, the economy is just having a real long grind out of a decent slowdown last year and obviously the massive volatility during COVID where there's some really big slowdowns. Investor confidence actually is doing the same thing. It's low at the moment, but nowhere near as low as it was during the pandemic, when I think people had a stack of things that they were really concerned about, and understandably so. There's some parallels there. And likewise with consumer confidence, it's not great. And there's still a lot of headwinds for households, but it's not as bad as what we've seen over the past 5 years when it's at alarming levels for us. So what does all this mean? Well, we do think we're still in that grinding economic recovery. But from an investment perspective, investment confidence doesn't drive investment performance.
Right.
We weren't confident during the quarter, but the US share market hit an all-time high, for example.
Yeah.
Most people, if they looked at their KiwiSaver balance in April, probably would have maybe let out an expletive.
Yeah.
Like, goodness me.
Yeah.
But if they looked at it later on, they would have seen that it had come roaring back in many cases. We saw such a wide range of performance there, even though confidence itself was taking a little bit of knock with all the, I think, uncertainties that are faced here and abroad.
We're talking about confidence a lot, and confidence sort of leads to more confidence, and it doesn't take too much for a setback. Do you think that dip around April for markets, for those that are in, diversified funds and have investments and things, not everyone does. If you're just in TDs, it doesn't matter. But if it's almost one of those, if you didn't check your balance for a couple of weeks, you wouldn't have noticed much. But do you think for those that did see that, and experienced it, has that been a major confidence hit for people?
Yeah, I think it really does. And things like, say, for example, when I started saving in the 90s in a retirement fund, I got a letter once per quarter telling me what my balance was.
And that was it.
And that was it. And I could ring up the price line and listen to a tape recording of what the unit prices were and that sort of thing. Yeah. Now people are seeing it on their phone.
In real time.
Yeah, so there's no such thing short of deleting the app to go, just put it in the bottom of your drawer and forget about it. You don't need this retirement money until you retire.
Yeah.
So don't let these ups and downs wind you up. That doesn't happen when you're seeing it on your telephone each day.
And on your telephone.
Your cell phone, your device, whatever.
Yeah.
So I think people will see that and be alarmed. But likewise, if you're hey, I'll check this thing once a year sort of person, you're dead right. But it was a really big drop and one of the strongest bounce backs I can remember in terms of how the share market turned around and then in the States set further highs. So, but the volatility always creates a bit of uncertainty and can be a dent to confidence. And that comes back to where when I see things like this, I think, this could trigger off a bit of work if people start to ring up a lot and go, should I be switching? Should I be withdrawing and all that sort of stuff? This quarter's been a great example of, well, if you've got a long-term goal with this money, you need to ride these things out and it certainly paid off for people to have stuck with it rather than panic, even though it was quite worrying when we look at things like the Liberation Day tariffs announced on the back at the start of April, which rattled markets' cage.
But there's always something else to worry markets. Markets climb a wall of worry, they say. Yeah, but this is kind of the multi-billion-dollar question. But do you anticipate any other significant risks or potential setbacks on the horizon? I mean, I know that that's. If you knew that.
I think that there's a couple of things that are really challenging in the global economy and the New Zealand economy to a certain extent at the moment. And if we look at the top of the pile, the US, clearly they're having some challenges. The economy's been rolling along pretty nicely. Government's running a deficit, which is supporting overall activity. The outlook for companies is pretty reasonable. But in the here and now, the labour market data over recent months has been really soft in the States. Inflation's still fairly persistent. So the challenge and the risk is, what does the Fed do? Do they worry about inflation, which has been what they've been doing all this year? Or do they worry that they've had their foot on the brake, if you like, for too long and they need to support the economy? Now, in New Zealand's case, we're in a slightly different situation. We've been getting fairly clear signals that the economy's spluttering along in this grinding recovery that we've been chatting about. And the Reserve Bank has cut a lot, and we're now thinking that they'll do a little bit more. So we really are at the end of our easing cycle, whereas the Fed's had quite a big pause. It's always hard for central banks to manage those conflicting forces of inflation but slowing growth. The other bit in there that I think is interesting to watch is the US debt market. The US government runs a big deficit, and whenever you're doing as much change as what the Trump administration's doing. We had the big, beautiful bill. For an example, we've got the tariffs going on. The tariffs are bringing in tax revenue for the government, but they've still got that deficit there. And I think that has to be monitored. And if we look at what's happening in very long-term interest rates, I don't think the world's got an insatiable appetite for US debt or any other governments that's running a large deficit.
Yes. Eventually the credit card balance, you max out.
Yeah, that's it. So I think the bond market is the thing that gives me the jitters every now and then.
So it sniffs out things,
as much as the share market volatility, which I think is just part of investing.
So with the survey kind of saying that, or clearly indicating at the moment investor confidence has taken a hit, one thing I've been thinking about is that, and you've touched on it in terms of the latest quarter's performance, you don't need euphoric or across-the-board positive investor sentiment to drive positive investment performance, or vice versa, potentially. You could have, really, really good performance and the market will go against you. Why do you think, this is always the case? Is it almost like a Goldilocks is some positive, some negative?
Yeah, I think the one factor in that impacts this survey a lot, I think, and where we differ from, say, the States, housing is such a big part of confidence in New Zealand. Like if we think what's a positive driver for consumer sentiment in the States, job security, decent performance of the share market. So there's a wealth effect, if you like, from people seeing their retirement funds
more
go
so
up.
Those things and a bit of housing, whereas we're a lot of housing.
We're a lot of housing. So hand in hand with this survey that we're focusing on a range of investments, we also do a housing confidence survey to see how people are feeling about the housing market. And of course, we monitor housing market data,
Yeah, of course.
and do forecasts for where we think prices are going. So I think part of this, when we say, hey, overall confidence is down, we have to have a look and go, well, what are people thinking about housing as well? Because that will be a big part of the mood. And the housing market's gone sideways for the year.
Yes.
I think it eventually will pick up. But if we think about the easing cycle we've had, the fall in mortgages that we've had over the past year, people were quite rightly wondering, why aren't we seeing the housing market go a bit better now? So that feeds into this investor confidence survey as well, is what's happening with housing. And interestingly, when we talk about that, when people think of housing as an investment, well, I always find it a bit weird when people think their own home is an investment, because you live in it, but it certainly is a big part of your balance sheet. But if you're in the rental property game, then these flat prices will be impacting things. But is now a good time to buy perspective, which is what we asked within the housing confidence survey, people are thinking now's a good time to buy.
Okay.
But they're coming up from a different angle. They like the fact that house prices aren't going up at a great rate. They like the fact that mortgages are coming down. So even when we're looking at something like housing, I joked about this last podcast.
Yeah.
People love it when economists go, oh, it depends. But what you feel about the market now really does depend. I think for first home buyers, they're probably thinking, hey, I maybe need to have a really good look around and get my ducks in a row. But if you're a property investor, or you're looking at, say, something like, we all got our rates bills and our latest CVs, and you see it going down, that's a negative thing that will be driving into other people's sentiment.
I guess, if you're a first-home buyer, you may realise it's a buyer's market, but if you're less confident about the other things, you might not get off the chair and do something.
This is where the economy ties in with the overall mood, as if you're not confident in job security, and the labour market is still really soft. There's less employment now in terms of the numbers of people working now than there were a year ago. That impacts your ability and your desire to take on debt. And so, I think it's going to be really interesting to watch how the housing market over the next year behaves, and whether that feeds into a pickup in overall housing market activity and sentiment.
I tend to think that we want a housing market that is warm. Like, good gains for holders, but not enough that it makes things unattainable for those that are buying. And that would sort of, kickstart, but without it, I'm kind of flat across the board.
You'd always expect to see some house price inflation. I mean, as long as there's inflation in the economy, the cost of building a house is going to go up.
Yeah.
But now we've got these interesting dynamics where the demand factor is not as strong as what it was a few years ago, because we're just not getting the population growth coming in through net migration flows that we were. So there's all sorts of things happening there, even though the main driver people think about, lower interest rates, is in play now and is usually part of the next growth phase for housing. But hey, along the way too, just again tying a couple of themes of lower interest rates and other assets, the New Zealand share market has been a bit of a laggard for quite a while, but it's actually had a couple of good months, and that classic pattern we see where, hey, term deposit rates come down, people think, where can I get a bit of yield? And your dividend generating New Zealand stocks, some of those utilities, etc., that are known as good dividend payers,
4%, 5%, 6%,
7%, are back in favour, and there is some good stories. It always makes me happy to see the New Zealand share market going well and playing a part in people's investments.
Another driver of confidence. So if we turn our minds to kind of investors and their own strategies, with all this, it's not really volatile. I mean, there's been volatility, but it's kind of almost like just muddling along potentially. What should investors be thinking about, in your opinion, or is it still the same old things we talk about every time?
I think for people that are particularly looking at property as their investment and term deposits, it's really important to keep abreast of what's happening in interest rate markets. We really are at an interesting part of the cycle here. If the Reserve Bank is near to the bottom, So people need to think, okay, well, what does low interest rates mean for me as a borrower?
Yes.
How long might they hang around for? Likewise for savers with term deposits to go, what's the story here? What's realistic for me to expect? And that's where some of the reports we write are trying to give some information for people to help with their decision making on those fronts. I think for your diversified funds, you manage investment funds, KiwiSaver, etc., it's the same stuff. Sticking to your long-term goals,
Yes.
managing your investments based on your risk profile and your overall financial goals and plan. Things like this quarter have actually just been what we want people to experience to go, hey, it's a good for calibrating your risk tolerance to go through a choppy month or two like we did back at the start of the second quarter. But hopefully the other lesson people get out of it is that if you're focusing on the long term, we have to accept that we're going to see periods of share market volatility.
And if you had, I guess, for an average investor, and that could be someone who's just maybe owns a home or an investment property or a single TD or a couple of TDs and maybe a KiwiSaver account. During times like this where there's not massive drawdowns happening, it's not euphoric, are there any key things that you think, before we wrap up, as a final question, things that they should keep in mind? Is it just almost like don't worry or make some decisions?
Yeah, I guess it depends on what stage you're at. 10 years ago when I saw big dips in the market, I just saw them as massive opportunities. Now I'm starting to think, okay, well, if I'm retired in less than 10 years' time, what should I be thinking about this sort of volatility? And weirdly, when I go into the branch or something like that and get online and do the risk profile test, it's already telling me, as someone in their second half of their 50s, should you be considering a more balanced fund rather than having all your assets stacked up at the aggressive end of the scale. So I think that's an ongoing process for people to think about where they're at. Is volatility an opportunity for you, or is it something you start to need to think more and more about managing as you get to the income stage of your investment life?
But it's still a depending on you and all your personal circumstances and all those things we know, full and well, there's still a job for funds to do. And there's still a job for TDs to do.
Absolutely.
Right.
Yep.
Yeah. Okay.
Yep. No, I think that. And the other thing that times like this make you realise when there is uncertainty is the importance of some of the other financial guidance that people generally get about making sure you've got rainy day funds and that sort of thing, so that you can weather this sort of thing out.
Thank you for giving up your time, because we know you're a very busy pilot who also, moonlights as an economist, and you're attending more and more events across the nation. Just to wrap up, I guess, what's the main takeaway from this quarter's survey that you want listeners to kind of have in mind for amongst the next 3 months?
The takeaway for me is people understandably don't have a very high level of investor confidence at the moment, but that doesn't translate into it's a bad time for investing.
Right,
There's some asset classes like housing where it might feed into low investor confidence, but it's also maybe feeding into those opportunities we talked about for first home buyers that might be thinking, I like prices going nowhere. I like interest rates being low. So thinking where you're at in your investment life at times like this, when there's some alarming headlines, but there's also been some quite an interesting range of returns from different asset classes over the past year, really. It's just worth reflecting on how does that impact you.
Is it fair to say that if you wait for the perfect time, it's probably not the perfect time?
Yeah, I haven't seen someone waving a flag to go, now's the perfect time. Come on back into the water, it's fine. Yeah. All the sharks have gone.
Right, yeah. Because, again, I guess, by that time, you've probably missed your chance. So to our final question now, CTB, you know this one well. What's something you've been reading, listening to, or watching that you could recommend?
I did know you'd ask this, and the first answer is always I've been reading The Economist.
Okay, yes, yeah.
But I, when I went on my trip down to Nelson, I chucked in a few books that I was going to reread, just in case I had time. Vietnam War Story, Once a Warrior King.
Wow,
it's a good read.
Nice and light.
Yeah.
Okay.
But at the other end of the scale, Tintin.
Oh, yes.
Been reading a bit of Tintin.
Okay. So books about the comics or the comics themselves?
Oh, both. I've got a book about the writing of the comics, how it evolved from a comic strip to the books and things that I thought it was the latest and greatest thing when I got my first Tintin book in the 70s, but that was really at the tail end of it. The Tintin's been going on for ages. So,
and you've got a Tintin T-shirt on today.
I've got a Tintin T-shirt.
Okay, all right. We'll let the listeners imagine that it's got Captain Haddock on it,
Yeah,
and Tintin, correct?
And Tintin, and I've got another couple of T-shirts that have got other characters on them.
You love a novelty T-shirt, don't you? So what my one?
Would you prefer this one for your Christmas present, or the one I was wearing last week with the cat flying the plane?
I think the cat one is so ostentatious. I'd probably take that one.
Okay,
yeah,
I'll bear that in mind.
Okay, yeah. Well, if you get me one, I'll wear it. What have I got? I've got a shout out to Kurtan from Auckland University, who had on a couple of weeks ago to talk about passion investing. He sent me a paper that's on my reading pile of railroad bailouts in the Great Depression.
Wow!
Now that is niche, but I'm going to make my way through it. So I think that he brought it up because I think there's parallels around the government getting involved in companies in the States, and sort of what impact does that have long term. And then also I had a shout out to Karen at Grant Thornton, who I met at an Infins event this week. Listens to every episode, and the favourite one was investing in your 40s with Nairi.
Yeah, that was a great podcast.
And Karen had the great idea. We want to hear ones on investing in your 20s and 30s. So I was like, plug for that, we need to come back and we'll be recording some of them in due course.
And I obviously put bits and pieces about investing in your 50s in each podcast because that's what I'm doing.
That's right. So we're covering all the decades. CTB, thanks for giving up your precious time. As always, it's a pleasure having you here on the show and talk about all your interesting hobbies and niche passion areas.
Thank you.
I hope you have a good week ahead. And until next time, happy investing, everyone, and it's bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.